Welcome all to the Node. I am Mike, aka Veteran Crypto, and this is your place for news, interviews, and education. We're going to jump right into it. David will be joining us shortly, I'm sure. But until he does, let's pop over here. If you are wanting to take advantage of all of the free educational material that we offer, this is the place to do it. So if you want to jump over to the node.pro, this is where we have a full DeFi and crypto and TradFi education. If you want to understand why it is that many of us get into crypto, because of just kind of honestly the crooked banking system that we have and our inflationary fiat, the reason that we're kind of wanting to become financially sovereign from the financial markets and from the dollar, this is the place to do it. So if you want to come here and go to the Learn tab, and you can find free of charge. We do not charge for this. You can go through the courses. There's quizzes. It's structured. All you got to do is start the first lesson, and this is the modules. You go through it, and again, it's free. I don't know what else to say about it really. So this is a great place to get started. If you're curious, I always have people asking, where can I get started, learn about DeFi? Where's a good place to learn about this? This is the best place. There's a lot of people out there that are offering schools, they're offering, educational materials, things like that. But every single one of them out there is going to charge you for it. We give it away. We genuinely are educators here. We are not influencers. We are not trying to, shill any, these products to get you to buy them behind paywalls, and then once you get in there, there's not a whole lot of value. We pull back the curtain. Here you go. You have no excuse to not know about this stuff. We also, our Intel library, all of the deep dives we do today, we're doing Lighter and Robinhood, but every single deep dive, 13 deep dives a week, we post them in here free of charge. All you have to do is come in here, and if you're curious about a project, we're just going down the line. Jeff does the kind of the deep dives on the small cap projects, the new, kind of potentially hidden gems. And myself and David are going through the higher cap. And so we're just kind of, working towards the middle, and we're going to meet in the middle. But this is where you can go. And if you're curious about any of these, you can click on them. And there's a short, 8 to 10 minute video that just gives you the down and dirty on what is this project, what is it about the token, does it have good value capture, all those sorts of things. What do you need to know to get a basic idea of is this a project I should even pay attention to? Is it a token that I want to invest in? That kind of thing. You can read through material. We also have the slide decks, basically the PowerPoint presentation. We have the infographic, which is basically the elevator pitch that will just give you the really down and dirty. And then at the last document we have is the source document. So this is what we build the deep dive off of. And if you scroll to the very end, this is something I haven't seen anybody else do. And it is so important because it is what separates opinion from fact. It separates, shilling and just, poor quality information with good, solid quality information, is citing your sources. So at the end of each of these source documents, we hyperlink every place that we got information to build these deep dives. And the reason we do this is if you are bullish or bearish, or you find where we made mistakes, because we're here to learn as well, and we're not perfect. But if you find where we made a mistake, all we ask, you don't need to come at us with guns blazing. Just get a hold of us on X, get a hold of us on our website, wherever. Let us know what we got wrong. Cite your source, so that we can go and check and verify, just like we're doing, return the favor. We did the same thing. Show us where we got it wrong, and we are more than happy, if you are correct, to change our material. We want to give good information out. We're not here to hype any project. We're not here to shill any project. We are here to simply give you the facts so that you can decide for yourself what you want to invest in. Me and David do not give a shit what you invest in. It affects us in no way whatsoever. We are simply here to try to be a voice of reason in the sea of influencers that are just trying to, give you that endorphin hit to get you to subscribe, to get you to follow so they get eyeballs so they can make money. Me and David and Jeff got tired of it. We started this channel as a channel of integrity. We are here to simply give you the information and you can do whatever you want with it. So with that, how's it going, David?
Doing great, Mike. Doing really great, man. What a night last night. So, dude, I could just tell you a quick story. So outside of this bar, right, and these three like teenage girls walk up. They're one of them is like, she's taller than me. I'm 6'3". She was like maybe 6'4", like blonde, like tall blonde chick, really big, but she was beautiful though. If you can imagine like a 6'4" Barbie.
Oh, so you're talking like a freaking like a Viking princess or something?
Yes, dude. And so she's from Georgia, and you know what she was carrying when she walked up?
She was carrying the country or the state? Well, the country,
the state. Okay. So she's this blonde 6'4" Barbie from like Norse. She's like Norse or whatever, but from Georgia. Yeah. And she walks up and she's carrying a hubcap. So like she was carrying like a hubcap she picked up off the road. Yeah, man. No, just a lot of fun. Great night. I love it out here on the beach, dude. It is amazing. But what you were saying, Mike, about we're here to learn together. Like I don't know anything special, like I don't have like special knowledge about the future or any of these projects or anything. I'm just here to learn about this stuff. And, being able to do it with you, Mike, and with Jeff and with everyone else, that's what makes it fun, man. And I hope that everyone gets something from, the community and all the learning materials that we put out and all the intel that we put out. I just hope that people get something from it.
Yeah, no, like it says here, one team, one dream. Silence, and in the naked light I saw. Just he's just living his best life. He's just trying to help out paddling. So it's all about the teamwork. Teamwork makes.
What exactly is he? He's just fucking eating her ass right there. Is that
he has his face buried in her big ass, paddling along, living his best life. All right, so let's jump into it. So this is the kind of stuff.
Speaking of eating ass, Ripple.
Yes. Yeah. So this is the kind of thing that inspired us to start this channel. This is what I'm talking about. So, this guy here, Steph is crypto. And I'm going to point it out because this is just straight up like false. And 82,000 followers.
Wow.
And it's from Shilling. So listen to this. It says the DTCC CEO, Frank LaSala, says, the 114 trillion tokenization initiative launching on July 15th on Ripple and Stellar could bring new levels of liquidity and transparency and efficiency. Our vision is coming to fruition.
No, it's not.
It is not. This is 100% false. Ripple Prime is part of a 50-plus panel that is working with the DTCC on tokenization. They are, as of right now, there is nothing slated to go live on the XRPL or with Ripple. As of right now, the only official projects being launched is a soft launch on Canton, supposedly this week or towards the end of this month. And in October, if it all goes well with the soft launch, a full launch. There is rumors and some pretty strong support that in H1, the first half of 2027, potentially they'll go live on XLM. As David has pointed out, there is still some issues with the XLM and Stellar as far as functionality and then being able to go fully live. They need to make some adjustments. So, like I said, we are here to state facts. I'm not fudding Ripple. I'm setting the facts straight.
And Mike, you could actually hop into the Intel library, and if you hop into the Stellar, the XLM deep dive dossier, if you hop into that, there's quite a bit of interesting information about exactly what is broken with Stellar.
Yeah.
I'm pretty sure, if memory serves, that there are 2 companies that make up like all of the trading volume, all of the volume on the Ripple, or not Ripple, on the Stellar chain. Pretty sure it's 2 companies. I think it's a shipping company and then like another company.
Mm-hmm. So if you want to find that, just go to the node.pro, click Intel library, under search, just type in XLM. And there you go. If you don't take my word for it, go ahead and watch the deep dive. Again, we hyperlink our sources. Feel free to go through. If you feel like that we got something wrong, please, by all means. One Armed Bandit in the chat is saying Stellar now integrated Pi payments. I'm not sure what that is.
So you remember Pi? That project? It was like I think it was a Chinese project launched on cell phones like a couple of years ago. And then finally they did something. They turned it into a chain, I think. I don't know much about it, but
that Pi project. But I'm wondering if this has anything to do with the DTCC, or is this just something else?
Yeah, Pi Network. Yeah, that's what he's talking about.
Yeah, Pi Network, friends, mobile first mining. I mean, and that's great. Now, we're not saying that. Again, we're not saying that any of these projects that that we talk about aren't going to make money and they're not doing good things. We just want to make sure that you have good, solid information and that you're not being misled by stuff like this. Because there's a lot of people out there that would read something like this and be like, "Oh shit, I need to go out and buy me some XRP because they're the DTCC is launching on Ripple on July 15th," and that is not the case in any way, shape, or form.
You're exactly right, Mike. And this is a great example of a piece of content that is very misleading, because you take a look at this and you see, oh well, what is that? That's a big number, $114 trillion. Wow, it's getting tokenized on Ripple and Stellar. I better buy me some XRP and XLM. When really, like, that statement on its face is actually false. Yeah, that's a false statement, and it's also quite misleading. Now, that's not to say that Ripple, XRP, or Stellar's XLM. That's not to say that those tokens may not perform well. They may perform well.
And down the line, the DTCC may launch on the XRPL, or on Stellar, fully. Like I said, the first half of next year, they're supposed to launch on Stellar if they can, line up everything. But we are just here to tell you the facts as they stand. As they evolve, we'll update our information. We do not do speculation here. We can, talk about what we think might happen and things like that, but I'm not investing off of that. I'm not investing off of. You have to weight speculation differently than current facts as they are. You can't weight them the same. There's a lot less value in speculation. You can guess all you want. And if you want to invest that way, there is a lot higher risk and potentially a lot higher reward. But when you're taking that higher risk on high market cap, projects like XLM and XRP, there isn't a whole lot of upside. So speculating like that, I don't see the risk reward. If you want to speculate on a low cap, that's one thing. But if you're speculating on something that is like the number 5, market cap, with like, what is it, $70 billion market cap,
right?
That's a risky move.
Where do you think it's going to go? It's going to go from 70 billion to what, 150 billion? You think it's going to double? What's the driver? What's the catalyst for the double? I don't see it. But maybe it's out there. I just don't see it, because that trifecta that we're always talking about. Mike, all this deep dive research that we've done led us to build our trifecta. It's user adoption, user growth. You need real product market fit. And then those users on that chain need to drive real revenues. And then those revenues need to accrue to token holders in some way. That is the trifecta. And so, going through all this research, that's really what we've taken away from all of it, is that if a coin doesn't satisfy the trifecta, it's unlikely to perform well. That's not to say that it won't have some type of pump at some point. That's not to say that you can't make money on it. Of course you can. You could get long, you could get short, whatever you want to do. But this is what we're all about, because I want to be able to buy stuff and hold it and get a 10 bagger out of it without having to, stay up nights. I want to be able to sleep at night knowing that I did all my research and I know what I'm investing in and I went in eyes open. That's important to me.
Absolutely. And, it's something else we focus on here is, David is our subject matter expert on DeFi. It's how he makes his entire living and has for, the past 5-6 years. A lot
since
of these
2022. I've been full time since 22.
And a lot of these assets, we are able to, use DeFi and earn yield. So, Hype and, a lot of these other tokens, you can use them in DeFi and earn yield off of them. And with that solid value capture, we've seen, they move separate from the rest of the market. Projects like Hype, even Canton, even with its recent pullback. There's a lot of these tokens, Tron and and many others, BNB, that have outperformed Bitcoin and the overall market. While they've all bled off, these tokens that we've been talking about for months and months and months, that have value capture, they've been outperforming the market. There's a lot of we were the first ones to really start talking about value capture. We were one of the. I posted this morning. We were one of the first ones, like the day that Canton Network popped its head up like a groundhog on RWA.xyz. I just posted a interview. I invited Drew from Discover Crypto to come on our show. What was it, like 6-7 months ago or something like that? To interview Shaw, the one of the co-founders of Digital Asset and the creators of Canton Network, and we were one of the first ones to start covering it. And I'm glad to see other people. And there's people that are much, Scott that was on the show Friday, much more knowledgeable about it than I am. But and it's good to see. Definitely we don't have a corner on the market, but because we focus on facts, because we focus on data, because we're always looking for these value capture coins and tokens, we have been very, very good at identifying also problem projects. So, Aave, 2 weeks before, it had its issues. We did a deep dive and saw some issues with the DAO leaving, with the risk team leaving, with the developers leaving, with the pooled liquidity issues. We kind of saw some red flags.
And then what happened?
Yep. Well, David pulled his liquidity off of there, his life savings off of there.
I got very lucky. That timing, man. Oof. Very lucky.
3 days before, he was able to do that. And there were some other projects, that we've covered before Zcash, the day before that, that potential exploit.
That orchard bug. Yeah.
Orchard
where
bug.
It's like, hey, just trust me, bro, on the supply.
Yeah.
I don't know why Zcash is still trading. What? It's like, I want to say 500 or something like that. I'm just very surprised.
Well, the end of this month, it was like the 26th or something like that. They're supposed to be, last I heard, they're launching that side chain or fork to where people are going to be able to move their tokens over and they'll be able to see if there was an exploit or not.
I mean, all right. But I'm taking a look at Zcash right now. It's trading $540. So putting in a little bit of a double top over the last, it looks like 4 weeks or so. But hey, if Zcash breaks out above 550, then the next target on the upside is 645. So, as much as I might think that the supply of Zcash, I still think it's up in the air. We don't know exactly what the supply is right now.
Yep.
That doesn't mean it can't pop, obviously.
No, absolutely. And DSI, it's, Zcash is my main bet. I think it's going to outperform hard. That very well could be the case. I mean, just because something, just because we're not bullish on it here, or we don't feel like it has value capture and stuff like that, we'll say it over and over. It doesn't mean you can't make money on the project. like as much as we beat up on XRP, we always say, it's shown, it has zero value capture. I mean, well, very little. Yet it pumps all the time. There's enough mind share, there's enough hype around it. People that post false information, and it gets people to buy it. And with that retail buying pressure, we saw. I mean, I was one of the top holders. I was in the top 2-3%. I had over 40,000 XRP, and my average buy-in was at like 32 cents or something like that. I sold at $2. It went up to $3 plus, but I saw that as my escape pump. I got out because
so for these projects, Mike, like just because we point out facts, not FUD, does not mean that you can't make money with it. Of course you can.
You can day trade and scalp trade, and there's a million ways to make money.
Yeah, and when it comes to Zcash, it's actually a very interesting project, and there's potential there for sure. But we would be remiss if we didn't point out all of the facts as they are now. So based on the facts as I know them to be true, I couldn't buy Zcash.
Well, we just don't know the supply. That's right. The facts. We don't know if there was somebody infinitely printing more Zcash until this fix that they are going to be launching at the end of the month, and that supposedly is going to show if there was an exploit, because people will be able to move their tokens over if all 21 million get moved over, and everyone's comes out and says, "Yep, I moved all my tokens," and there's no extra tokens. Are people left on the old chain or whatever? Then that will show that there wasn't an exploit. If 21 million get moved, and there's still people saying, "Hey, mine are still on over here in the in the old space," then that means that somebody was printing extra tokens.
And Mike, speaking of, and I'd be surprised if there was not some type of exploit there. I think it's likely that there probably was. I mean, whoever knew about that for the last, I think that's been a long running exploit, right? That bug, isn't it like a 4-year-old bug or something like that?
It's been in there since it launched.
Wow. Yeah. So look, you just got to know about that. It's totally fine if you have conviction and you think, hey, they're going to be able to fix that problem. And because of the selective disclosure that you have on Zcash, okay, great, there's a use case for that. And it seems as though institutions might want to adopt that at some point because of that ability to selectively disclose. So, hey, there's value in that, I'm sure. It's just not for me, But Mike, speaking of stuff that's launching by the end of the month, Aerodrome, right? Streaming rewards. Yeah.
What's that?
Streaming rewards. Isn't that what they're calling it? They're calling it streaming, I think.
Yeah. Where instead of doing the epochs where you get them on a Wednesday, it's just going to be constant trickle into your account.
Yep. I was reading a little bit about that last night.
Very, very excited about, and I wish they would just release all the details so that we could cover it.
Me too.
And I want to know the details about the tokenomics. I want to know the details about the new platform, the new protocol, and the functionality, and the different ways that we can potentially earn and harvest. Because I've read a bunch of stuff on how we're going to be able to harvest from our they're not locks anymore, they're stakes. It's going to be S arrow instead of VE arrow. So I'm just excited to see what all that looks like, because I am heavily invested in the Arrow token, the current Arrow token. I've had locks for years now, and been harvesting that yield and rolling it back into more Arrow, but auto compounding. I would love to be able to, if we see really good price appreciation on Arrow, and we get $3, $4, $5 or something like that, because it's already gone to $2 and change, with all the new changes going multi-chain, a lot of the institutional vaults and things like that they're saying that are rolling out, a lot of the liquidity provision with Coinbase and a lot of other potential institutions. I guess there is going to be a way for retail builders to use Aerodrome as basically liquidity. So if you want to build out a DApp or something like that, to where they're going to do borrowing and lending, or you need liquidity provision, you'll be able to use a SD, it's not an SDK, or maybe is it SDK?
It could be. I don't know. I don't know exactly how they have that set up there, but the term for me that I find so interesting about these new Arrow tokenomics, and I'm actually very interested in these new Arrow tokenomics. I think that they get that right. And dude, look, I mean, they own the trading volume on Base.
Yeah.
That's the only chain where Uniswap is about to take a third, or I think they might have actually started doing that, taking a third of the fees from their V4 pools on every chain. So if you provide liquidity on Uniswap V4 on any chain, it looks like a third of those fees that should be going to you are going to instead go to Uni.
Except on Base.
On Base.
Except on Base, because
they've got to compete.
They're in competition with Aerodrome.
Right. Yeah. And I think so the term is predictive streaming rewards. I think that's the terminology that I saw.
That sounds
the way that those VE Arrow locks function now, it's a bootstrapping mechanism for new token launches. And it works. It works well. But it's almost backwards looking. And so this new model, it seems like it's going to be more forward looking. Like, where are the rewards supposed to be moving forward? So I really want to learn more about that. I can't wait to see that launch. I think it could be really great, actually.
And we'll see. Like I said, it's my largest holding. Full disclosure. But there's still a lot of unknowns. There's still risk involved because we don't know the details. I did my locks, back way before we knew they were going multi-chain and going to do merge with Velodrome and launch a new platform. And so I mean I'm ride or die at this point. I'm locked in. I don't have a choice. But I'm liking what I'm seeing. But at the same time, we got to be real, just like with Canton. We always point out, as bullish as we are on Canton, we've had a couple of interviews with one of the founders. We got to point out the facts. It's still inflationary. We got to be fully transparent about these things. If you're going to be, if you're going to have integrity, if you're going to, try to educate people, you got to point out the good and the bad. So,
Mike, I was just looking at markets here as you were speaking, looking at CC, but also Bitcoin, ETH, Sol, etc. And nice moves today. Nice moves. Big upside day today. Very, very good to see. The thing that I like most about Canton, though, is that it is less positively correlated with Bitcoin. Just about everything in the digital asset space is positively correlated with Bitcoin in some way, but CC kind of trades in its own little universe. I like that. It's less correlated. I really like that.
Well, I mean, pretty much it seems like all these tokens that we've identified as having value capture are like that.
They tend to be. They outperform. Yeah.
Tron, Hype, CC, BNB. What else? I got them on my watch list.
Unfortunately, Ethereum and Solana, not too much outperformance there. I saw someone posted in our community earlier today that ramen noodles outperformed Ethereum over the last couple of years. Hey, Mike, I'm going to grab some more coffee. I'll be right back.
All right. So the ones that we've identified so far is BNB, Tron, Hyperliquid, Canton, Near, Uniswap, Tau, we just did a deep dive on them. The JST token, Jupiter. We're going to be doing a deep dive on Lighter today. It's looking very, very promising. Aerodrome to an extent, and that's about it that we've identified so far. But did we figure out why the DTCC partnered with Stellar instead of other chains? It does feel weird. I honestly, I do not know why. But we in our deep dive and understanding Stellar and Jeb McCaleb and all of that, I see that there is a lot of functionality issues that need to be addressed before they're going to be able to go live. And they are things, and the reason that Canton was chosen, in my opinion, is because I'm not a fly on the wall in the room or anything. But if you look at Canton, it was purpose built for this. It was purpose built for TradFi, institutions, governments, things like that. All those things, the decentralized stuff that that we love, it doesn't really have them. Well, I can't say that. But privacy, it has that adjustable privacy where whoever is using it, whatever their use case is for it, they can selectively decide what aspects of a transaction are transparent and public. KYC and AML built into it. Just all those different starts with the C. What's the word I'm looking for? Compliance. All the compliance functionality was purpose built into Canton. A lot of these other chains, they are adding those things after the fact. That is what makes Canton different. That is why we're seeing the mass adoption of Canton Network. And I'm not talking about MOUs. I'm not talking about rumors of that they were sitting on the same stage during an interview, boom, this is bullish. That's not what I'm talking about. I'm talking about that there's official announcements, official partnerships where they are either actively building right now on Canton Network or they have gone live. Very
you see
different.
What Crispy said in the chat here, Mike? He says, I think Canton's going to be huge. I just don't like what it represents. And I mean, you know what? There's a part of me that really agrees with that statement.
Yeah.
Because I prefer the parallel financial system to TradFi. I prefer, sovereign digital assets to traditional finance. But, I've got to respect what Canton is building, man. I mean, it is really an amazing and very interesting project because of the adoption. I mean, all of the developers that are building cool stuff on Canton. I mean, my goodness, I was going through yesterday during the premium call with members and just running through all of these different projects that are being built on Canton. I mean, there is so much stuff coming in the pipeline there.
Yeah. Oh, let's see. So it looks like Coin Bureau saying that the European Central Bank will launch a 12-month digital euro pilot test in the second half of 2027 with 36 payment service providers. Deutsche Bank, Unicredit, Revolut, and Stripe will test online, offline, and in-store payments across the EU along with other PSPs. So, news like this is a daily occurrence now. This, if you're not paying it, I'm sure if you're watching this, you're paying attention, but this is proof that this technology is not a fad. It's not going away. It's not a matter of if, blockchain technology is going to be adopted. It's really just picking the winners. Which ones are getting the true adoption, which ones actually generate fees and revenue so they can keep the lights on, so they can, it's a business, so that they can pay the bills, so that they can hire the sharpest minds and the best programmers or the best developers, so that they can always improve their products and services for their customers. These are going to be the Amazons, the Googles, the ones that the cream that rises to the top. There's a 95% or more of crypto projects, mark my words, are going to go away. There is going to be 5%, probably a lot less, out of the tens of millions of projects that are in crypto right now that are going to survive.
How many projects would you say that there are? I know that there's a ton of coins, like 50 million coins or something, but I wonder how many actual legitimate protocols there are with their own tokens. I think it's probably measured in like the thousands, maybe maybe 2,000, 3,000, something like that.
Well, I know it might be a little bit off, but could you type into Gemini, out of the 54 million cryptos, how many are actual projects and not meme coins? Something along those lines. I'd be curious to know.
Okay. Digital assets. How many are actual projects and not just meme coins. So, if you're trying to whittle this down, right? You're trying to take this massive universe of coins and tokens and whittle it down to the, let's say, half a dozen that you think you can invest in long term to perform really, really well and outperform the S&P, outperform holding treasuries, of course. Well, that's why the deep dive research is so important. So it looks like of the millions, Mike, 99.9% of them are just created low effort meme coins. And it looks like the tracked ecosystem, it's around 20,000 protocols.
Okay.
But the actual projects within that 20,000, it's about 1/10 of that. So between 2,000 and 3,000 actual like projects with coins, protocols. Yeah.
That's actually, you know what? Break that down real quick. So I want people to understand, the weight of that. Because
Sure.
all of the liquidity that's in this market, potentially, once the vaporware is eliminated, once all the bullshit, and there's always going to be meme coins. People that meme coin casino always going to be around. But once all the vaporware goes away, once people see where the actual value is, and people start flooding into those projects, like we see in the tech industry, in the Magnificent Seven, when all of that liquidity starts getting focused and all the attention starts to get focused into these top projects, what do you think is going to happen?
I think they're going to perform extremely well. I think that this past bull cycle that we had for Bitcoin, we never got that euphoria on the way up. We didn't get a true parabola out of BTC this past bull. And I think that's probably the reason why we didn't get a true alt season, because there was no cash to rotate into alts. There weren't, there wasn't a 10x return on BTC where people had, were flush with cash and could go and, buy altcoins. So we never really got a true alt season this past bull. And, part of it could have been those Bitcoin ETF products. That's my thesis. I think that the Bitcoin ETF products had the effect of compressing Bitcoin's volatility. And I think that's probably the reason why we didn't get the parabola. It also could be that there were millions upon millions of tokens launched that sucked liquidity away from legit projects. So of those millions,
being one of them.
Oh man, that marked the top for Solana. That Trump meme coin. And that was not a good idea. He should not have done that. I'll call it how I see it. I love President Trump, but my God, man, he should not have done that. Bad look. Yeah. But of those millions and millions of coins, the vast majority of those millions, they are low effort meme coins. So thanks to all these launch pads that we have now, anyone can mint a token in 30 seconds for less than $1. And so the analysis that Google Gemini just ran through for me says that the vast majority of those, they lose all trading volume and essentially they die within 24 hours. Now, the tracked ecosystem on major tracking platforms like CoinMarketCap or CoinGecko or maybe even investing.com, they track crypto assets too. They filter the chaos of those meme coins and they only list tokens that meet certain baseline requirements for volume and liquidity and active trading markets. That tracked ecosystem, Mike, Gemini says, is between 10,000 and 20,000 coins. But you've got to whittle it down much further. You're not going to have a portfolio of 10,000 coins, are you? So the actual projects in there is between 2,000 and 3,000, Gemini says. So, and that's based on GitHub repos. So if I'm, a developer, right, and I'm building a project, I'm going to have a remote repo, and I'm going to use that repo to ship code to production. So there's between 2,000 and 3,000 actual functional crypto projects. And then once you whittle it down to those 2,000 or 3,000, now you got to figure out, okay, what am I looking for to determine the handful that I buy?
Value capture,
right?
What value does the token that you're buying have? Other than, just perceived value, other than just speculation. other than people, trading it, people, looking for those speculative pumps, people buying because of hype, things like that, or selling because of FUD. It works both ways. So, that is the next way that I would whittle them down. And that's what we're trying to do here. We're trying to identify, and we don't have a crystal ball, out of the ones that we've identified so far. They might, not, some of them might fold up shop. We don't know. But we are here to give you the information as new information comes in so that we can help you make your decision. You decide on if you're going to buy a project, if you're going to hold a project, if you're going to sell a project. We're just here to give you information.
It's a learning experience. We're here to learn about this stuff together, so we do this for a living. We're out here every single day learning about these projects and coins and tokens and protocols. We're all about getting the highest quality information that we possibly can get. And what we've found is that if a project has real adoption, real user growth, real product market fit, and those users generate real revenues for that project, and those real revenues accrue to token holders in some way, there's value capture. If a coin satisfies our trifecta, we think that it's likely to outperform.
Nope. Wrong.
You see what Ismail said? Your voice is making us sleepy.
Wait until you hear Paulo's voice on the red pill. That guy has
my goodness.
That guy has a velvet voice. That Portuguese.
He does.
Call him the Portuguese velvet. But
oh man, so what you got here, Mike, with CPI? Because I think that could have been the reason why we got a nice pump today.
Yeah. So I want to get your input on it. So the U.S. stock market futures surge as U.S. CPI inflation posts its largest monthly decline since April of 2020 during COVID. I've seen some things that show that potentially that this is not the whole picture, though, because of I believe it was gas, like oil, that they feel like that it could be kind of a manipulated, indicator. I mean, what are you seeing, David?
Yeah, well, I mean, the fear was that CPI was going to come in hot, and CPI did not come in hot this morning. Now, I believe that we're also going to get PPI tomorrow morning. So PPI is Producer Price Index. And the fear here was that with the war in Iran and crude oil prices, up a couple of months ago at $110, $115, $119, I believe was the top, that was going to feed through into everything else in the economy. That was going to push inflation up. And so now that we're actually seeing CPI fall by 0.4% of 1% month on month, that's a really large single month decline. In fact, it's the largest single month decline since April 2020. So that's a big, big net positive for markets. And we're seeing digital asset markets, react positively to those news today. And, if I just take a look here, the thing that I'm tracking most closely is yields. I'm tracking yields on the 10-year.
Yeah.
Because, even though we got that cool CPI print this morning, yields have really not paired their gains all that much. We're still seeing, the 10-year up at 4.578%, as of right now, as I'm speaking. So that's not exactly, a pulling back at all. In fact, it's broken out above a level of resistance, and it's got a level of resistance just a little bit higher at 4.70%. So if yields continue to push higher, what that tells me, Mike, is that CPI print that we got this morning, it may be, and I hate to use this word, but I'm going to anyway, it may be transitory. So yields are telling me that inflation might remain sticky. Now, if we see yields really pull back, that would be a big net positive. Here's a reason why yields might not pull back, though. The federal government of the United States, it's deficit spending. We cannot continue to deficit spend to the tune of, $2 trillion a year? We can't continue to do that and expect that yields will not push higher. So that's something that the federal government really needs to curtail. And so whenever I hear Lynn Alden speak about nothing stops this train, when she makes that statement, nothing stops this train, I think she's absolutely right, man, because the Fed could at some point find itself stuck between a rock and a hard place. If inflation continues to push higher, let's say that this cool CPI print this morning was transitory and we get higher inflation prints over the next couple of months, maybe this flare up in Iran continues. Because I mean, I see crude as of right now today trading $79. So with crude at $79, that is a sharp rally from where crude was just a couple of days ago. I mean, you know, a couple of days ago, at the beginning of the month, you know, we're talking about not even 2 weeks ago, 12 days ago, on Thursday, the 2nd of July.
You want to share your screen?
Sure. Let's take a look at this. So on Thursday, the 2nd of July, we had crude oil sitting at, what was it, $67? I mean, right there, $67 for crude. So all I've got on my chart here is 2 levels. So all you need to be able to do to read a chart is you need to be able to identify support, resistance, and trend. If you can do those 3 things, you're ahead of 99.9% of technical analysts out there. You know, sometimes I'll see guys who, you know, have their charts up and it looks like they've got spaghetti drawn all over. They'll be like, oh, so, you know, you got this, and then, oh, so that means moon. You know, it's like,
you got like 80 indicators on.
Right. You don't need any of that. All you need is a level of resistance. Okay, where's the level of resistance for crude? Well, let's go ahead and zoom out here to a weekly. And on the weekly, when in doubt, zoom out. So on the weekly, as we zoom out here and go back in time, you see this level of trend line resistance that I've drawn in? This is a long-term level of trend line resistance. Okay, great. So we've got a pivot high up here. Those were the July 2008 highs for crude oil, up around $150. That's my anchor point. I anchor my trend line to that high, and then I drag it down and I connect it to the next lower high. And as I extend that to the right.
Are you using the candles, the bodies, or are you using the wicks?
I tend to use the wicks. However, sometimes, and this is why technical analysis is sometimes more of an art form than an exact science, I tend to cut off the wicks if there's a good reason to do so. So like this wick here, this was I believe this was the invasion of Ukraine, that pump in crude oil there. Yeah. And it came from, you know, that was the March and April, that was the spring 2020 negative crude oil prices.
Oh, yeah, when they were like, if you had a place to store it, they were basically giving away oil.
yeah, because the world was getting shut down. Yeah. But yeah, that pump over the course of, basically 24 months, I cut off this wick up here. But it's interesting to see this as we zoom out. You know, this level of resistance marked the top for the Iran war pump. So now that we've got a level of resistance on the upside, so Crispy's asking, what time frame do you start at? I usually start with a weekly. I like to start with a weekly. Now, the thing for digital asset markets, though, is that many of these assets don't have enough data, where you really can't zoom out to a weekly. So after I start on the weekly, I'll identify a level of resistance. Now, I want to go ahead and zoom in.
Time frame possible where you get some good data.
Exactly. Start by zooming out, and then you can zoom into a daily. And then if you want to trade intraday, maybe you zoom into a 4-hour, or maybe you zoom into an hourly, or maybe if you want to be muy picante, you want to get spicy with it, you zoom into a 15-minute. I even know some people who trade 5-minute candles. Now, I don't know that I would really want to do that, but some people do, and they can be profitable doing so. It's just a little bit too fast-paced for me. So I've got that level of resistance on the upside, right, for crude oil at 120, let's call it. Now, what is this horizontal here? Why have I drawn in this horizontal? Well, because we've got something called a gap. So you see this gap down, Mike, right there? Yep. And that was on, let's see, what day was that? That was a Friday. So going into the weekend. So there was on the Friday, and that was June 12th. So Friday, June 12th, we had a gap lower. So that was between the Friday close, when the futures close on Friday at 5 p.m. Eastern Standard Time, and then open back up the following Sunday at 6 p.m. Eastern Standard Time. So in between the close and the open, crude oil gapped lower. And so when it gapped lower, gaps tend to fill. So now that crude has found a bottom and has started to rally, I would expect that this would be a level of resistance on the upside, that you get the gap fill, and then that could be all she wrote for crude, depending on what happens in Iran. So it's very, crude oil right now seems to be driven by the news cycle, whatever is coming out of the Middle East. And it seems to be kind of interesting that we're seeing all of these Gulf states, Kuwait, Iraq, Qatar, UAE, Oman, these are all American allies now. And so these American allies in the Gulf, they are armed by us. We've sold them weapons, and they are starting to use those weapons to defend themselves against those crazy Shiite clerics in Iran who are lobbing drones and missiles across that 50-mile Gulf. So we're seeing, those Arab nations in the Middle East start to fight back with US-made weapons, specifically the HIMARS. And so that news cycle is driving crude oil right now. And so that's why, look, we live on X. We need this news because this is what drives markets. So now that we know, okay, there's a lot going on in the Middle East, it's driving crude oil prices. And with the re-escalation of hostilities, we're seeing crude push back to the upside. Well, we've got a level of resistance all the way up here at 120. Unlikely that we see that tested again. But maybe we see this level of resistance here, this gap fill. Maybe we see this get tested as resistance. So just seeing that really cool CPI print today at the same time that we're seeing crude oil push higher, interesting dynamic. So it's great, though, to see Bitcoin pushing back to the upside. And so Bitcoin today, Mike, breaking out. So if we zoom in here a little ways, we can see these highs here. Let me just go ahead and mark this so that we can all see this. These two highs. Mm-hmm. So that high, that was on Monday, July 6th. And that high on that candle there came in at $64,700 even. And today, the high on the candle today, 64,966 earlier today. So the fact, it broke out. It broke out. So it's put in, not quite yet. It hasn't, but we did get a technical breakout. So the fact that Bitcoin has pushed above these recent highs tells me that it's likely to continue its rally. So where's the next level of resistance then? Well, let's go ahead and zoom out just a little ways. That next level of resistance comes in right here, this high. And that high was from Monday, June 15th. And that high came in at, let's call it $67,300. So $67,300 for BTC. So now that Bitcoin has broken out above these two highs, I would expect that it would rally all the way up to 67K or so. And so if we zoom out there, we can see that there's what's referred to as a confluence forming up here. So you've got a couple of different levels that are telling you that there's going to be significant resistance up here. So, hey, you know what? In the midterm year, in the Bitcoin bear market year, in the month of July, the prophecy, I call it the prophecy, it's the Bitcoin cycle. Whatever drives that Bitcoin cycle, I can't quite put my finger on exactly what drives that cycle. It could be, having, who knows, whatever drives that cycle tells us that in July, in the Bitcoin bear market year, you should expect a rally. And the guy who has been absolutely the very best at calling the Bitcoin cycle is Benjamin Cowen. And when Ben Cowen speaks, I listen because he has been prophetic. He has been correct. I tend to like to listen to the people who have been right, and Ben Cowen has been right. And what he's saying here is that we get a rally into the end of the month, which then fails, okay? So the Bitcoin bear market is not over. And whenever people say, oh, this time is different or this time is going to be different, I kind of think to myself, well, maybe it won't be different. And so if we just zoom out here, Mike, real quick on BTC before we continue on with the news, or hop into the deep dives, I know we've only got a couple of minutes, take a look at this repeating pattern on BTC. I find this to be very interesting. We have these, Bitcoin likes to put in the same types of patterns over and over again. So it likes falling wedges. It likes rising wedges. It likes inverse head and shoulders patterns, head and shoulders patterns. It likes to put in flags, bull flags and bear flags. And so we see it put in these patterns over and over. Back here in 2017, you see that pattern? There's the falling wedge. What did we do in 2020, 2021, 2022? Another falling wedge. And what have we seen so far since 2024? Bitcoin has put in another falling wedge. These are very bullish price action patterns. But the bear market for BTC is not yet over. The bear market, according to the prophecy, the Bitcoin prophecy, is supposed to end in the first week of October. So if it ends in the first week of October and the cycle repeats, this pattern just repeats again, well, then I think we likely see Bitcoin test 50K by the beginning of the fall. So I'm really looking forward to being able to deploy some capital into digital assets in the fall. But I think it's a little bit premature right now. Not just me.
All right. Well, let's jump over to this last piece of news before we get into the deep dives. Let's take this out, throw that up. So Galaxy blends Aave, Morpho, and other DeFi rates in new GOFR crypto borrowing product. So it looks like, Spark, Camino, and others to offer a blended borrowing rate. Users will borrow capital from Galaxy, which will act as the sole intermediary between the accredited investors and the blockchain-based lending protocols. Galaxy Digital has unveiled a new fully managed crypto lending program targeting institutions, high net worth individuals, and accredited investors who want to borrow from major DeFi protocols but prefer to keep Galaxy as the intermediary. So this is going to bring liquidity to those platforms. So the so-called Galaxy on-chain financing rate, GOFR, will offer borrowers a single continuously rebalanced rate by tapping on-chain lending protocols like Aave, Morpho, Spark, Camino, and others. I don't have anything to support this, but with what I've been reading, that could include protocols like Aerodrome, because they're institutional offerings. According to the announcement on Tuesday, it will then blend those protocols' variable borrowing rates into an optimized rate. Users are only borrowing from Galaxy as their sole counterparty. The announcement notes, institutions have been clear. The opportunity in on-chain credit is real, but the infrastructure required to access it directly isn't something they want to build on their own. They've seen the issues with Aave and others. Galaxy head of lending, Max Baris, said in a statement, to that end, Galaxy will manage any wallets, private keys, and smart contract interactions. So basically, they'll be the custodian, while sourcing, executing, and monitoring positions. Users will also be able to post native Bitcoin directly as collateral, with Galaxy handling any wrapping on their behalf. And we've seen with some projects that potentially wrapping won't be necessary. This is not only a managed intermediary crypto lending product, a category that has seen fairly steady growth. Coinbase, for instance, launched a lending service where eligible users can borrow USDC against their Bitcoin, ETH, and Sol holdings by sourcing loans on Morpho. So we're seeing more and more alignment where these institutions and centralized exchanges, and TradFi is using these in the background, are using these DeFi platforms. Again, Morpho, Aave, Uniswap, potentially Aerodrome and others as a liquidity provision, for their offerings. So all this is going to do is, these are the things that we look for here on this channel. This is the adoption part of the trifecta. As you see these institutions adopting these different DeFi protocols and providing liquidity and using liquidity, things like that, that is the movement of money. That is what generates fees and revenue. And if the token that we buy has value capture to where those fees and revenue, either directly or indirectly, are shared with us, the token holder. We benefit from that. If there isn't value capture, any price movement is pure speculation. I cannot stress that enough, and we're gonna keep saying that because it's factual. Any price movement, if the token is not, it's not a security. There is no contractual obligation between you and the company. It is you basically are buying the meme coin of a project that you're bullish on. And that's not a bad thing. Like we said, it doesn't mean the price can't go up. It doesn't mean that if a good amount of the people decide that there's no value there and they start dumping the coin, just like a meme coin, that the price can't dump dramatically or go to zero. So we might not get those 50 or 100 X's, but we are looking for good, steady growth on our assets. And where we see that value is tokens that meet our trifecta, that are getting adopted, that generate fees and revenue, and that have solid value capture for us, the token.
So exactly, David. Right. Yeah. So Mike, about this gopher, and by the way, just real quick, I'm not looking for a lottery ticket type play. Would I love to hit a 50 bagger or a 100 bagger? Of course, but that's not what I'm looking for, though. So just as an aside, but as you were talking about gopher, GOFR, it reminded me of, have you ever heard of LIBOR or SOFR before? So LIBOR was the London Interbank Offer Rate, and SOFR is the Secured Overnight Financing Rate. And so I think what Galaxy Digital could be doing there with Gopher is it looks like they're building a digital asset version of SOFR, the Secured Overnight Financing Rate. So that is, SOFR is the foundational interest rate benchmark that's used by financial markets to price US dollar denominated loans, derivatives, and other types of financial contracts. And it's managed and published every business day at 8 a.m. Eastern by the Federal Reserve Bank of New York. So SOFR reflects the cost of borrowing cash overnight when the loan is fully secured by US Treasury securities. It looks to me like Gopher, GOFR, is the digital asset version of SOFR. And it looks like Galaxy Digital is creating that Gopher. So I think that, this is just another sign of major adoption. And so, we've talked about the mullet, the mullet banking, where we're going to see more.
Front, party in the back. Yeah,
exactly. Yeah, we're going to see more and more of this, I think, where you see institutions start to use digital asset rails in the back end, but in the front end, they use the traditional Web 2 type stuff that everyone's already familiar with. So,
and that's the onboarding. That's the adoption we're talking about. Is what traditionally kept a lot of institutions, a lot of experienced investors in TradFi and stuff like that, out of these markets is a lot of the speculation, the lack of regulatory, clarity, and also, just having to navigate, the onboarding process. Having to get access, to these DeFi platforms, using hot wallets and just wallets in general, worried about custody of keys and all of those sorts of things. So a lot of these institutions that are now going to be custodying the liquidity for these different institutions, they're going to do all that for them, because we're starting to get the clarity to where they legally can do that, whereas before they couldn't legally do that. So, again, I can't stress this enough. These are the things you need to be, fundamentals that you need to be paying attention to, not social media posts that are hyping a project or that are giving you those endorphin hits. This stuff is boring. If you ran across this, just in the news, where Galaxy blends DeFi with TradFi, you'd probably just go right past it, because it doesn't say boom. It doesn't say, this changes everything for, insert, crypto project here. You don't get that. It doesn't have like all the flashy colors and the eye-catching stuff that that people that hype projects like to use. This is just boring.
And there's all this jargon. You see what Andrew Munns is saying in the chat? Sofer, gopher, fofer. I mean, look, man, if we're talking about gopher, like, what is that? The Galaxy Overnight Funding Rate? Is that what it stands for?
Yeah.
Right? Yeah. So, I mean, look, this is dense, like in the weeds, boring stuff. But if you really want to be informed, I think that you would do well to learn about it a little bit. So, Mike, I'm ready to rock and roll, man, on these deep dives. I'm really looking forward to it. Lighter and Robinhood chain today. And so I've actually got awesome. So I've got right now Lighter. I've got the chart of Lighter pulled up here. And we're going to take a look at Lighter first. Now, this is a perps dex, and Lighter has been performing extremely well over the last, looks like the last couple of months. So after putting in a trough at 83 cents, Lighter rallied by 230%, all the way up to just about $2.75. That is a phenomenal performance over the last couple of months. And take a look at the performance today, plus nearly 12% on the back of that cool CPI print. However, it's quite extended from this level of support and still trading below this level of resistance at $2.75. So even though we got a great pump today, still just keep in mind the level of resistance comes in at $2.75. Get above $2.75, and this thing enters price discovery again, where it could really just rip. So let's learn a little bit here about Lighter. I'm going to go ahead and pop into the deep dive Intel library here, and you can go ahead and take a look at this on your own if you'd like to at the node.pro. Sure. You can take a look at this at the node.pro. If you hop in there, here's our official website. This is the node.pro. If you jump into the Intel library, then you can run through all of the deep dive research as we go through it. So we're going to go ahead and take a look at Lighter here first. I'm really excited to take a look at this. Oh, and by the way, you can share all of this deep dive content over here in the source room. This is our community that we've been building out here. You can see all of the other members in here. You can DM people. You can talk about, whatever it is that we're talking about in any of our shows. At our main node show, that's the one that you're watching right now, Crypto and Chill, that's with Jeff and Mike, and the Daily Market Wrap, that's the one that I run every day at 4 p.m. Eastern Standard Time. So I'm just going to hop into the node right there, and I've got this piece of deep dive research content, and I'm just going to say, I'm really looking forward to running through this deep dive research right now. And then I can go ahead and post this. And so we can have a conversation about facts. We cite our sources. So if there's anything that you think is incorrect, jump into the deep dive research, point it out, we'll fix it. Okay, let's go ahead and play this piece of video content.
Decentralized finance has struggled for years to replicate the execution speeds of traditional exchanges. When developers attempt to run a central limit order book, a CLOB, directly on general-purpose Ethereum Layer 2 networks, the architecture inherently drags. High-frequency trading engines require dedicated, isolated throughput. When forced to compete for shared block space and manage state contention alongside everyday token transfers and NFT mints, these matching engines collapse under the latency. To make matters worse, executing a limit order book within standard zero-knowledge circuits introduces a massive computational hurdle. Proving price-time priority, ensuring that the earliest orders at the best prices execute first, is historically too complex for standard cryptographic proofs. Standard processing pipelines buckle and fracture when attempting to sort these massive, simultaneous data inputs in real time. Lighter protocol bypassed these bottlenecks by engineering an application-specific zero-knowledge rollup designed exclusively to host a central limit order book and margin engine. By completely isolating its execution environment, Lighter processes perpetual futures trades with latencies under 200 milliseconds. Yet, because it is built directly on top of the Ethereum mainnet, this custom architecture still inherits the ironclad base layer security of Ethereum itself. But building a high-performance matching engine solves only the technical half of the decentralized exchange equation. The economic model requires equal precision. In June 2026, Lighter implemented a structural overhaul of its token economics. introducing a strict mandate to systematically capture value from the exchange's trading volume.
Okay, super important. We're always talking about the trifecta. We need to see real user adoption, and that user adoption needs to drive real revenues. And when we see user adoption and revenues, those revenues need to accrue to token holders in some way. And so that is what we are seeing here with Lighter.
Lighter translates centralized exchange-grade off-chain execution into deterministic on-chain deflationary value for its native LIT token. And crucially, it achieves this economic sync without triggering US securities regulations. Lighter relies on an isolated operational triad, an off-chain sequencer, a custom Plonky2 off-chain prover, and an on-chain Layer 1 verifier contract. The off-chain sequencer handles the immediate execution of incoming transactions, processing them on a strict first-in, first-out basis. To solve the computational weight of proving that price-time priority logic, Lighter utilizes a specialized data structure called the order book tree. This model maps the order book tree, merging a standard Merkle tree directly into a prefix tree structure. By mapping data this way, exact price-time priority is encoded into the terminal leaf indexes, collapsing the matching logic proof complexity to a constant O of 1. Armed with this computational efficiency, the sequencer pre-commits to trades instantly, granting users the soft finality they expect from a centralized exchange. To settle these trades, the protocol uses a multi-layered proof system. The initial Plunky2 Stark proofs generated by the off-chain prover are wrapped into a Plunk-based Snark proof using a NARK implementation. This final Snark proof is verified on-chain by the Ethereum smart contract. This mathematical constraint ensures the off-chain sequencer cannot deviate from the predefined rulebook without the proof being outright rejected. The order book tree architecture guarantees institutional-grade transaction speed off-chain, while the cryptographic proofs enforce the strict self-custodial settlement guarantees of the base layer. Lighter generates organic revenue through a bifurcated volume strategy. Standard accounts feature zero maker and taker fees to funnel retail onboarding, while specialized premium accounts charge fees to professional market makers. High-frequency trading firms strictly require optimized API latency and minimal taker fees to run their systematic strategies profitably. This table displays the relationship between staked lit, fee discounts, and taker latency. Staking 10,000 lit reduces latency to 180 milliseconds and grants a 10% discount. At the maximum tier, staking 500,000 LIT drops latency to 140 milliseconds, cutting fees by 30. Distributing direct fee-sharing dividends to token holders risks classifying LIT as an unregistered security. Prior to June 2026, the protocol accumulated exchange revenues in a discretionary treasury. The June overhaul stripped that discretion, replacing it with a purely automated, systematic framework. This flow diagram details the new automated mechanics. Premium fees, liquidation penalties, and LLP yields flow into a smart contract executing continuous TWAP buybacks of LIT on the open market. 100% of these repurchase tokens are permanently routed to a null burn address.
So, Mike, this is what we're always talking about. This value accrual model, the buyback and burn. We're always looking for this.
Well, and more of even these older projects, that didn't have value capture. We're starting to see a lot of them start to do votes. If they have a DAO, they're starting to do votes to try to make adjustments to their tokenomics to align more, with some value capture, because I think they understand that if they want to keep getting that retail interest or just investor interest in people buying the token, people are wanting to see this.
They are. We're going to keep hammering home that trifecta. We're going to keep talking about that till the cows come home, because that is the most important thing when it comes to valuing digital assets, I think.
For us, the token holder, absolutely.
Exactly. You need user adoption. And those users need to drive real revenues for the protocol. And those revenues need to accrue to token holders in some way. And so we see similar mechanisms over and over and over again. The buyback and burn. This is what we see over and over. So this is what we look for.
Immediate market impact of this overhaul materialized in July 2026, when Lighter executed its inaugural revenue-funded burn of 15.6 million tokens. That single transaction permanently eradicated over 6% of the active circulating float from the market. To evaluate the operational cost of maintaining mandatory staking requirements, we have to look at the targeted 6% APY required to reward the ecosystem stakers. This table projects Lighter's ecosystem runway across varying staking scenarios. Looking at the current state row, 125 million tokens are staked, representing 53.3% of the active supply. Against the fixed ecosystem reserve, this exact emission rate guarantees a 33.33-year operational runway. Because the protocol systematically destroys supply using real trading revenue while financing yield from a secure multi-decade reserve, Lighter operates as a hard-coded deflationary engine rather than an inflationary loop.
Wow.
To continuously feed that deflationary engine, Lighter relies on an enterprise scaling strategy called Lighter Domains, designed to funnel external retail volume inward. The core proof of concept is the Robinhood chain integration, which embeds customized instances of Lighter's exact matching engine natively inside the consumer-facing Robinhood wallet.
Wow. So, Mike, we're going to do the deep dive research on Robinhood chain in a couple of minutes here. But just as an aside, real quick, I believe Lighter has also been selected as the, I guess, official perps dex for Telegram, I want to say. I read that somewhere. Look, I saw it on the internet, so it must be true. But I think it is. Yeah.
This domain utilizes Paxos's USDG stablecoin as collateral, providing Lighter with a non-trading, yield-sharing revenue stream strictly from the assets deposited on the platform. The vulnerability in this model is volume dependence. If premium institutional trading volume declines, the revenue-funded buyback and burn engine stalls entirely. This split screen models the protocol's tension. Left, incoming retail volume from the Robinhood domain flows inward. Right, a massive supply spike hits December 30, 2026, marking the lockup expiration for insiders. From then on, 13.88 million LIT tokens unlock monthly for 36 consecutive months.
Ouch. Oof, man, that's not good. So let's see how they resolve that problem.
This creates an intense mechanical race. The engine must generate enough trading revenue to crush the rapidly expanding token supply before it overwhelms the baseline. The long-term viability of the token rests on this exact tension: organic buy pressure from enterprise adoption versus the mechanical supply dilution from early insiders. Lighter engineered a cryptographic and economic architecture capable of handling the highest speeds of institutional finance. If its enterprise growth can outpace its impending emission schedule, Lighter is positioned to dominate the regulated on-chain derivatives market.
Okay, so the tokenomics there look pretty solid right now, but I'm really happy that the deep dive research was able to highlight the fact that on December 30th of this year, there's going to be the start of a massive token unlock where it said every single month there's going to be, 13 million LIT tokens unlocked. So you got to be aware of that, right? Now, does that mean that you can't make money with Lighter? Absolutely not. You can. And the performance of the token tells us that, hey, if it breaks out above $2.75, it could rip quite a bit higher. But you got to be aware of the fact that at the end of this year, there's going to be a massive token unlock schedule that's coming. So yeah, man, this looks like a really interesting protocol to me. We see that user adoption that we talk about. We see that real revenue growth, and we see value accrual to the LIT token through the programmatic buyback and burn. But there's a problem. The problem is, starting at the end of this year, there's going to be a massive wave of token unlocks. So, having these facts and these data, super important. All righty, let's bring it on back here to the node.pro. Again, this is our official website. If you want to run through all of this deep dive research content with us, all you got to do is hop into the Intel library. And if you want this delivered to your inbox every day, sign up for a free account, and then you'll get these deep dive pieces of research delivered to your inbox. Let's go ahead and hop in here to Robinhood Chain. Now, let's see here. I want to go ahead and share this to the source room. And I just want to say, let's learn about Robinhood Chain. And so we can go ahead and post this content in the Node channel. There we go. And so anyone who wants to run through this and talk about this piece of deep dive research in our community, it's right here. Alrighty, Intel Library, Robinhood Chain. Let's go ahead and play this piece of content.
This dashboard tracks the July 1st, 2026 mainnet launch
David,
of
really
the
quick.
Robinhood chain. In its
If those of you watching, we greatly appreciate that you're here and learning. If you could, it doesn't cost anything. If you could, please just like, and if you find the information valuable, subscribe. It helps us grow the channel. We don't monetize, as far as we don't charge for a lot of the stuff that we give away on our website. We bootstrap this, so we're not a huge channel. We don't have we're not in a warehouse, or we don't have big offices or anything like that. We pay for it. David and Jeff pay for this out of pocket for all the different software and stuff to run this show for the past couple of years. So if you could, greatly appreciate if you like and subscribe. Thanks.
first 7 days, the network processed 17 million transactions across 350,000 distinct wallets, generating $3.1 billion in decentralized exchange volume. That immediate liquidity density placed the network fifth among all blockchains globally, trailing only Solana and BNB chain.
Amazing.
To handle this immediate influx of retail capital, the development team did not attempt to engineer a novel consensus mechanism from scratch. Instead, they deployed a highly optimized custom Layer 2 execution environment built directly on top of the Ethereum mainnet. Achieving institutional scale adoption on a public network requires specific architectural compromises. By bridging a strictly regulated brokerage to a decentralized protocol, the developers had to balance permissionless settlement with rigorous compliance. This side-by-side flow illustrates the exact divergence. A standard decentralized EVM architecture relies on chaotic mempool gas auctions and raw ERC20 tokens. Robinhood's Layer 2 replaces those mechanics with a controlled design, relying on linear sequencing and specialized token standards. This strict structural control provides three engineering solutions. It neutralizes transaction extraction, secures institutional yield routing, and solves the composability issues of tokenizing real-world equities. Deconstructing this exact architecture provides a complete blueprint for how traditional capital markets are migrating to run on public blockchain infrastructure. The network stack uses Arbitrum Orbit for computation, maintaining data availability by posting compressed batches to Ethereum using EIP 4844 blobs.
Okay, so this is important. Now, the fact that they're using Arbitrum, the Arbitrum stack, to launch that Robinhood chain, what that means is value accrues back to Arbitrum. Now, the ARB token, I think it's probably a good idea that we run through some deep dive research on ARB. I don't know a whole lot about the ARB tokenomics, but the fact that there's so much volume on this Robinhood chain, and a lot of that value accrues back to Arbitrum, I think we need to learn about that.
I'm going to take a look.
Creates massive settlement arbitrage. Launch week generated $843,000 in execution fees, paying only $1,600 to Ethereum for data anchoring.
Oh man, I saw that. So Mike, all these execution fees, but the layer 1 settlement cost back to the ETH mainnet was only $1,600. So where's the value accruing? Is it accruing to Arbitrum or mainnet?
It's not showing. The token price definitely is not showing it. I mean, Arbitrum is at 9 cents and the chart does not look good.
I know. But maybe there's an opportunity there. I just don't know. We need to run the research.
Yeah.
This table outlines the network's extreme speed. Offloading computation achieves 100 millisecond block times and sub-second soft confirmations. These are strictly sequencer guaranteed. True settlement occurs when the L2 batch locks orders on the Ethereum L1 inbox, progressing to irreversible L1 finality in 13 minutes. In standard public networks, transaction ordering relies on priority fees. Users pay higher gas prices to leapfrog pending operations, creating an environment where block space goes to the highest bidder. Robinhood Sequencer operates differently, utilizing a strict first-come, first-served model. Here, transaction ordering is determined solely by the exact arrival timestamp. By removing the ability to bid for block position, the sequencer neutralizes structural front-running and maximal extractable value exploitation. This establishes a highly predictable execution environment required to support automated, high-frequency commerce. Within days of launch, over 2,100 AI agents utilized the trading model context protocol to execute complex strategies across the network. To bridge the gap for human retail traders, the network integrates native account abstraction. This allows users to bypass manual seed phrase setups and execute gasless transactions directly through the Robinhood app.
Wow, that's amazing. So that is the mullet right there. So by abstracting away all of the complexity of Web3, DeFi, and crypto, and making the onboarding process as simple as click a couple of buttons and you're on the chain, that drives real user growth.
Combining strict timestamp sequencing with account abstraction hides the friction of Web3 entirely, providing users with a familiar The protocol allows users to capture roughly 7% APY on idle balances without manually interacting with a smart contract. This flowchart tracks capital. A retail user deposits USDG into a self-custody wallet, settling on Layer 2. Capital is routed into Stakehouse financial vaults operating on Morpho Markets infrastructure. Institutional borrowers pay the yield, posting liquid collateral like Spark, Athena, or
we're seeing, we're seeing this narrative repeating. We just got done talking about that gopher that's using Morpho and Aave and all these for liquidity and things like that. It looks like this is using it as well.
You know what I was thinking about as the narrator was going through that last bit there? I was thinking about USDG. I don't know anything about USDG. We've run, maybe it could be a good idea for us to run deep dive research on USDC, USDT, and USDG, because it seems as though these three stablecoin products are really driving a lot of adoption and user growth.
We did a deep dive on all the major stable coins a while back. I just don't remember if USDG was one of them.
I don't think so, but it might be a good idea, over the next couple of days, couple of weeks, to run through at least USDG just because of all of the adoption over here on this Robinhood chain.
To mitigate the inherent risks of decentralized lending, the supply chain is protected against smart contract bugs through dedicated insurance policies brokered by Lloyd's of London and Realm. The application serves as an invisible routing layer, taking retail stablecoins and deploying them directly into over-collateralized institutional credit pools. Yield generation is secondary to the flagship financial product, tokenized U.S. equities and ETFs that trade continuously, 24 hours a day, 7 days a week. This legal matrix outlines the assets. They are strictly tokenized debt securities issued by Robinhood Assets in Jersey, granting no direct beneficial ownership or legal voting rights in the underlying corporations. To protect holders, every token in circulation is backed 1-to-1 by physical shares held by a licensed U.S. custodian. If the Jersey issuer becomes insolvent, an independent security agent is mandated to liquidate custodial shares and distribute cash to token holders. Establishing the legal framework is only half the problem. Traditional rebasing tokens, which alter global supply balances to reflect cash dividends, create severe technical obstacles in decentralized finance. Altering total supply variables dynamically breaks the strict mathematical invariance of automated market makers like Uniswap and triggers massive database errors across external portfolio indexers. To bypass this infrastructure breakage, Robinhood co-authored a custom token standard, the ERC-8056 Scaled UI Amount Extension. The mathematical core of ERC-8056 relies on locking the primary variable. The raw on-chain token balance remains perfectly static, ensuring that AMM liquidity pools do not break when corporate actions occur. This formula demonstrates how that is achieved. It applies a dynamic UI multiplier, a fixed point parameter scaled to 18 decimals, which is used to calculate the actual underlying share equivalent units for the user interface. Consider the timeline of a corporate cash dividend. When a company issues a payout, physical cash is automatically reinvested to purchase additional shares by the off-chain custodian. Simultaneously, the smart contract proportionally increases the UI multiplier. The raw balance remains static, but the output increases to reflect new value. This yields a specific price calculation. Reinvested dividends increases the multiplier, so the asset drifts above the underlying stock price, tracking total returns. This updated fair value calculation is continuously calculated and then integrated back into the wider network via Chainlink Oracle data streams. The ERC 8056 formula mathematically insulates decentralized trading protocols from the chaotic volatility of traditional corporate actions. While the Layer 2 architecture and specialized token standards solve the user experience friction of DeFi, the entire system relies on heavy structural limitations. The most severe limitation is regulatory gating. To satisfy the strict compliance posture of the SEC, the flagship stock token ecosystem is geographically prohibited for retail users in the United States, the United Kingdom, and Canada. On a technical level, access and transaction ordering are entirely dependent on a single, centralized sequencer, exposing the network to corporate outage risks and potential censorship vectors. Furthermore, holding synthetic debt obligations issued out of Jersey carries distinct structural counterparty risks that holding actual, legally recognized shareholder equity does not. Finally, composing these specific assets into decentralized lending protocols introduces massive systemic vulnerability, as any disruption or manipulation of the external Chainlink oracles during corporate actions could trigger widespread liquidations. This ecosystem trades true decentralization for operational security. It operates as a highly regulated, centralized broker deploying its ledger onto a public blockchain rail. Despite
That's important. So it operates as essentially a centralized broker on a digital rail. That's important.
its geographic exclusions, the infrastructure successfully aggregates massive capital density. It connects public market makers like Uniswap, proprietary trading venues like Rialto, and autonomous agent hubs like Virtual's protocol, routing them all into a unified settlement layer. The synthesis of highly optimized optimistic rollups, native account abstraction, and advanced ERC token standards proves that traditional compliance checks can coexist with on-chain composability. The Robinhood chain provides the technical proof of concept for how legacy capital markets will eventually operate, with sub-second execution, total custody clarity, and continuous global liquidity.
Okay, so Mike, whenever I see a new chain launch with massive adoption like this, and we saw it with the base chain, we've seen it with other chains too, there tend to be protocols that pop up on these new chains. And those protocols, whenever they have a token launch, those tokens tend to perform extremely well. So let's see if we can find some interesting opportunities right now on the Robinhood chain. Now, to do that, I'm going to hop on over here to DeFi Llama. And on DeFi Llama, all I'm doing is I'm taking a look at the Robinhood chain itself. I want to go ahead and scroll down here. So just real quick though, these metrics that I'm seeing, phenomenally good for the Robinhood chain. This looks great. Now I want to go ahead and scroll down. What I'm looking for here are protocols where they exist only on one chain. So the protocols that exist only on one chain, those are Robinhood chain native protocols. And so if, let's say, Arcus, or because that's a protocol that is native to Robinhood, or maybe Meridian Predict, or Sheriff, if any of those three protocols have their own tokens, I want to know about that, because those tokens could be, maybe a lottery ticket type play, but could be a diamond in the rough type play. So just taking a look at those three, Arcus, Meridian, and Sheriff. Before we do that though, let's hop on over here to Dex Screener. Because on Dex Screener, I want to take a look and see, on X, I saw all the guys that were, essentially minted as fresh millionaires overnight with Cash Cat, that meme coin. That was a really big meme coin on Robinhood, and it continues to be the largest meme coin on Robinhood with $160 million market cap right now. I want to see, are there any other coins on the Robinhood chain that might offer interesting opportunities? So just taking a look, I want to familiarize myself with some of these coins. So we've got Cash Cat, we've got Wood, we've got Juggernaut, we've got Hood Rat. Okay, these look like meme coins to me. We've got Index. I'm not quite sure what the Index is. This could be interesting. What is the Index? Is this just another meme, or is this something else? So I'm scrolling down here on DeFi Llama, or this is Dex Screener, excuse me, and just taking a look here on the bottom right here. You see where it says the Index? I've got a link to a website. So it says Stock Dividend Protocol for Robinhood's Layer 2's tokenized stocks. So I want to click through to the website here. I just want to take a look at the index. So all we're doing here, Mike, is exploring this new chain. We're just exploring some of the protocols and coins that are native to Robinhood, because Robinhood has seen such phenomenal adoption and growth just since it's launched. So let's see here, the index, and the URL is theindex.finance. And so this is something that's completely new to me. So it says hold the index, earn stocks, a 3% ETH fee on trades, funds stock distributions for eligible holders. Okay, so keep in mind, Robinhood is highly regulated. So this is a highly regulated, centralized layer 2 chain built on top of Ethereum.
What that means is, they know all about compliance. They probably have an army of freaking lawyers that specialize in compliance with the SEC and the CFTC and all the different regulatory bodies. So this isn't something that potentially that if you're able to invest in it or something like that you could get blindsided by some basically regulation that comes out, or they get served with a Wells notice or something like that, to where you got to worry about it taking a dump.
That's a good point. That regulation there, that compliance is important. And if we take a look at the index.finance, what is it that we're looking at here? Like, what exactly is this? It says supported stocks. You know what? I want to hop into the documents, because I tend to judge new protocols by how good their documents section is. So let's see here. How do you use this? It says process, people trade index, trades route through Uniswap v4 index ETH pool. Okay. Number 2, the fee hook collects 3%. Great. So that's a v4 hook on their Uniswap v4 pool. It looks like it collects 3% in native ETH. So it says index is not taken by the hook. Got it. So it's just pulling ETH. And then step 3 here, the treasury buys stocks. So collected ETH is split across the supported stock basket of 18 stocks. And then step 4, the cycle is distributed. The distributor sends stocks under the active on-chain rules. Wow, this is really interesting. So what they're doing here is, it looks like they bootstrapped a liquidity pool on Uniswap v4 and then attached a hook contract to it to pull 3% of the ETH into an index that buys tokenized stocks on Robinhood chain. That's what this looks like to me. Wow, that's a pretty novel product. So if I click back on the home page, maybe if I hit swap, can I swap into this? Yeah, I can. So I can buy the index token with ETH. And it looks like when I buy that token with ETH, that hook contract on Uniswap v4 is going to take 3% and use that to buy those underlying assets, those stocks, those tokenized equities. So if we click on portfolio here, oh, wow, this is great. And the UI UX for this is awesome. This is clean, easy to read. There's no sometimes in crypto DeFi projects, you can get user interfaces that are kind of scammy looking. This is none of that. That is a big, big green. That's a good thing. Thumbs up for that. So let's see here. Supported stocks: Apple, AMD, Amazon, Bloom Energy, Coinbase, CoreWeave, Google, Intel, Meta, Microsoft,
has the Magnificent
Micron,
Seven. Yeah,
NVIDIA,
S&P 500.
Oracle, Palantir, SanDisk, SpaceX, Tesla, and USA Rare Earths. Okay. Wow. This is super cool, man. This is super cool. So let's hop on over here.
I wrote it down to do a deep dive on it. But what is it? I mean, did it say? Did I hear that right? Where it said that it pays like yield or dividends or something like that?
I don't know. Let's hop into the documents and see if we can find out. So it says why the fee is in ETH. So the fee asset, the protocol token collected as the fee asset, the index native ETH collected by the hook. Okay, so where are there distributions? Does it pay distributions? Where do distributions arrive? So it says they arrive in your wallet as stocks. Balances update after each distribution. Okay, do I need to claim or stake? It says no, distribution execution is handled by the active contracts and keeper flow. Okay, so what happens if I sell part of my balance? Well, future distributions depend on the wallet balance and contract state used for each active cycle. Okay, why did my distribution size change? It says distribution size depends on trading volume, route execution, available stock liquidity, and the active distributor state. Okay, is the countdown exact? Can protocol parameters change? All right, so I think that this is definitely worth a deeper look. And it looks like there's a timer here, some type of a countdown. I'm assuming that that is a countdown to maybe the next distribution. But now that we know a little bit about this index token, and again, the way that I found this token was over here on DEX Screener. And all I did when I hopped on over here to DEX Screener was I clicked on the Robinhood chain, and then I sorted by market cap. I just want to familiarize myself with the new tokens over here on this new Robinhood chain, just by taking a look at the largest tokens by market cap. And so that's how I found the index. So index looks like it's a $8 million market cap coin over here. Now, I believe this is simply a Uniswap V4 liquidity pool that's being tracked here. That's where these data come from. Yep, that's exactly what we're looking at here. And so this performance is phenomenal. It went from 0.2 of a penny all the way up to 0.8 of a penny is where it's trading now. But it looks like it actually got up to 1 full penny. Man. So that's over the course of, what is this? This is yesterday.
Yeah.
So from yesterday, that's a 450% move, man. What? Wow. So this is, if you see big moves like this, Mike, then what that tells me is liquidity provision might actually work here if the volumes are crazy high. And I think the volumes might be crazy high. Let's see if we can find out. So we're over here on Uniswap now, and we're in the Explore tab, and we clicked on Pools. And after we did that, then we went ahead here, and we're going to go ahead and make sure that we're on just the Robinhood chain, and we are. And then the protocol that we want to look at is just V4. So we're just looking at Uniswap V4 pools on the Robinhood chain. And so I want to go ahead and filter or sort by 1-day volume to TVL. So I'm looking for extremely high volume. That's what you need to be profitable as an LP. You need super.
There's that USDG.
Right? So ETH paired with USDG.
Yeah.
Now, here's the thing that you need to be cautious of whenever you pair a volatile asset with a stable coin in a liquidity pool. You need to be cautious of divergence loss, impermanent loss. So if you pair an asset that does not move, let's say it's pegged to 1, like a stable coin. If you pair that with an asset that does move, maybe something like Ethereum. Well, if Ethereum moves, it diverges from your entry by more than what you're earning in fees, then you're actually losing compared to just holding the coin. So you just got to be aware of that. Impermanent loss is super important to understand. So a lot of people will refer to stablecoin pools as impermanent loss factories because they are. So here's how you become profitable in an impermanent loss factory pool. Okay, just a volatile asset paired with a stable coin. Here's how you get to profitability. You need a ton of volume, man. Yeah. So if you provide liquidity in ETH paired with USDG, with ETH currently trading, what's it trading? 18 something, 1870. So if you were to provide liquidity in ETH paired with a stable coin right now, and let's say that you set a relatively narrow range, maybe, something like this. You use 1750 as support. And so maybe you want to just set an equidistant range, something like that. So 1750 is the lower bound of your range. Maybe 1980 is the upper bound of your range. If ETH moves up, then you're going to be converted into stable coins. If ETH moves down, then within your range, you're going to be converted more into ETH, okay? Now, what you need to be profitable...
Depending on the direction, it moves you into the underperforming asset.
Or moves you out of the outperforming asset. So
tomato, potato.
Same, but different.
Yeah, different.
Yeah. So, but here's how you get to profitability. If ETH rallies and your fees did not outpace your cost of volatility, your cost of volatility is your impermanent loss. That's your gamma. If ETH rallies and your fees did not outpace your gamma, that's your IL, then you would have been better off just holding the ETH. You would have made more by doing nothing, sitting in ETH outside of the pool. Now, how do you get to profitability? Well,
really quick, I want to point out that what David's saying right now is super valuable because there's a lot of people out there. This goes back to the influencer and educator dilemma. Influencers will put up thumbnails that have make $10,000 a month in liquidity pools, and they will only point out the fees that they make, and they do not point out, or they don't reveal the impermanent loss that they incurred. So it's like, so yes, they might have made $10,000 in fees, but they lost maybe 15, 12, $13,000 because of if they would have just held the asset. So
here's the thing. If let's say that because there's a lot of influencers out there, a lot of channels, a lot of guys who talk about liquidity provision as a way to earn passive yield, passive income.
It's not passive.
And it's like, it's not really a lie. It's just super misleading.
Yeah.
Because here's the thing. Let's say that you start out with $10,000 and you enter a liquidity pool, right? And you think to yourself, well, with volumes where they are now, I might be able to generate between 3 and 5% per month in fees. Okay, that's great. But what if you would have made more or lost less by doing nothing, by just holding that underlying asset? That's your impermanent loss. You've got to understand what impermanent loss is. There are very few pools where you can provide liquidity and earn yield and truly be profitable. There are very, very few of them. I would hazard to say that, 99% of pools are just simply not profitable. So how do you get to profitability? Well, let's say that you were to hop in to this pool with $10,000. And your expectation is that over the course of your first 30 days in that pool, the volumes are so high that you're going to be able to generate a 5% return, right? So 5% in fees. So on $10,000, that's $500. So you think to yourself, okay, I can make $500 over the next 30 days on a $10,000 investment in a liquidity pool, in Ethereum paired with a stable coin. Awesome. Well, what happens if ETH rallies within your range? That's great, right? You're earning yield, those fees, plus you're generating some price appreciation on your ETH. Here's the problem. As ETH rallies within your range, you're selling it on the way up. And people will mistakenly think, oh, well, I'm just DCAing out on the way up. Yeah, you are, but here's the problem with that. You would make more by just holding ETH. So that's inclusive of your fees. So that's your impermanent loss. So you got to ask yourself, if you're taking all this risk by providing liquidity in a pool, smart contract risk, counterparty risk, protocol risk, if you're taking all these risks on and ETH rallies within your range and you see your balance increase in that liquidity pool in US dollar terms, and you're earning yield on top of that price appreciation as you're getting swapped out of that ETH into stablecoins on the way up, you might think, oh, this is great. I'm earning on my assets in the pool. I'm earning those fees. Plus, ETH is rallying within my range, so I'm getting some price appreciation there. The problem is that impermanent loss is really significant, okay? So if you're getting converted out into stablecoins and you're earning
doesn't
fees,
it accelerate as it reaches the upper band?
So it accelerates on the way down.
Okay.
It accelerates on the way down. So at the bottom of your range, when you're paired with a stable coin, your gamma starts to spike. You get a gamma spike. It's almost like if you're trading options, it's referred to as pin risk, that gamma risk. So that's what impermanent loss is. Impermanent loss is your gamma. It's your cost of volatility. So and it's symmetrical in V2 pools, it is not symmetrical in V3 pools. So on the way down or on the way up, you're going to generate impermanent loss. The only way that you get to profitability is if your fees are greater than your impermanent loss. So it is not correct to think that you can step into a pool with $10,000 and generate 5% over the course of 30 days as an LP in a pool. It's not correct to think that that 5% is your profit. It's not. Because if you had 5% in divergence loss and you generated 5% in fees, those fees, you are the yield, okay? You didn't make a penny. And if price rallies within your range and you get converted out into stable coins and your fees are insufficient to cover your impermanent loss, your cost of volatility.
Another thing to keep in mind
you didn't
is
make anything.
When it goes out of range, you stop earning fees. So say ETH, takes off, then you end up it leaves that range at the top. You're all in stable coins, so you're not getting any price appreciation anymore, and you're outside of the range, so you're not earning fees. So if the market takes off, you stop earning totally. You're totally in stable coins, not earning fees as prices. Like if you're sleeping, if you're on an airplane, whatever, and the markets are taking off, you're left behind.
But it gets even worse than that, Mike, because people mistakenly think that, oh, well, I can just rebalance.
Yeah, auto rebalance. Yeah.
Or auto rebalance. And that is so dangerous. I would like to warn everyone against auto rebalancing and honestly, liquidity provision in general. Like you've really got to understand what you're doing when you provide concentrated liquidity anywhere, because the vast majority of liquidity provision is simply not profitable. So here's another reason why liquidity provision is usually not profitable. You don't have something that's referred to as positive variance. You don't have a variance risk premium when you provide concentrated liquidity. Here's what that means. So the volatility for the assets in the pool is lower than the volatility for those same assets in the pool external to the pool. Okay? Why is that important? Well, because there's something called toxic flow. That toxic flow is informed traders trading against your assets in the pool. Your assets in the pool, that ETH and that USDC, those assets don't know what the price is external to the pool, unless there's a Uniswap v4 hook contract with an oracle attached to it. But I haven't seen any of those yet. So that means that the assets in the pool are, I'm going to use the word quote unquote dumb, okay? They're dumb assets in the pool. And because those assets don't know what the price is external to the pool, if a trader who is faster than you are jumps in and swaps using your assets in the pool, that trader is informed on the current price external to the pool. So you have no positive variance. So you have no edge here. In fact, you have a negative edge. So this is something that you would never do if you're trading options. And these liquidity provision, these pools, they are options. That's what they are. These are complex derivative products.
So DSI has a question. So toxic flow is just for short-term liquidity providers, because if you just play longer term for a bounce, you tend to generate way less impermanent loss and profit even from informed traders.
Unfortunately, I don't believe that that is correct. So you can't profit from informed traders as an LP because you're always taking the opposite side of the trade but you're lacking the information that the informed traders have. The informed traders know what the current price is external to the pool. Your assets in the pool are dumb. They don't know what the current price is. And so if an informed trader who knows what the current price is can trade and swap using your assets in the pool, which have stale prices, that informed flow is always going to extract value from you. So here's another thing to think about. When you provide concentrated liquidity, you're trading a derivative, okay? This is very similar to if you're in an ETH stablecoin pool, it's very similar to being naked short a put. It's almost like if you provide liquidity equidistant, meaning the upper and lower bounds of your range are an equal percentage amount away from the mark price for that asset, that volatile asset in the pool. If you provide equidistant concentrated liquidity, it's almost like you're selling an at the money put. That's what it's like. And you can measure and trade these things just like options. They've got delta, gamma, theta, vega. So the delta here is always positive. You're always long when you provide concentrated liquidity. Your gamma is always negative. That's your permanent cost of volatility. That's your impermanent loss. Your theta, that's your fees. That's your fee generation. And your vega, you're always going to be, okay, so if you're providing concentrated liquidity, you must be negative vega. So short volatility. So your short volatility, your short gamma, your long delta, and your long theta. So your theta must be greater than your gamma for you to be profitable as an LP. And unfortunately, because you don't have positive variance risk premium when you provide concentrated liquidity, you're statistically unlikely to ever be profitable. The vast majority of LPs are not profitable. The vast majority. And the vast majority of pools simply don't have any positive variance. Here's an example of a pool that does. Let's say that you've got Paxos gold, PaxG, paired with XAUT, Tether gold. Those two assets don't move against one another much, if at all, because they're the same thing. So because those two assets don't move against one another, the price moves sideways. And when the price moves sideways in a liquidity pool like that, there's no impermanent loss or very, very little impermanent loss. And so what that means is your gamma, your short gamma, remember, that gamma, that impermanent loss is basically zero. So if you have basically zero impermanent loss, that means that whatever you earn in fees, that's your theta, that becomes profit. So you can essentially use a very low gamma pool, a very low impermanent loss pool as a replacement for a spot holding. So if you're going to hold XAUT or you're going to hold PaxG because you want some exposure to gold on chain, well, you're not going to earn any yield by holding that digital asset spot. But if instead of holding that spot asset, you instead hold a position in PaxG paired with XAUT in a Uniswap V3 or V4 liquidity pool, then it's almost like you replace that spot asset with the liquidity pool, because in the LP, in the liquidity pool, there's no gamma. PaxG and XAUT don't move against one another. They're the same thing. So that means that your theta.
So that would be like a way to, kind of very, very gently lever up, because, you keep exposure to the asset, but you're also stacking some yield on top of it.
Yeah. So, I wouldn't use the word lever up, but I would say that you're able to replace spot and earn yield.
Yeah.
So you've got that same exposure to price appreciation, right? Mm-hmm. Because it's a replacement for spot. You don't have much impermanent loss, if any, but you also earn the fees. So that is an example of a pool where your fees truly are your profit. If you're just in an ETH stablecoin pool, you kind of are the yield. So
let's address this and then maybe start wrapping up. We're about out of time, but it says, but they generate volume, and if you just LP on strong assets that will bounce, you will have a time edge, like when you invest longer term. That's how I see it.
So I think that there are a lot of logical fallacies out there when it comes to liquidity provision because it's so attractive, the idea of being able to provide an asset as liquidity or two assets as liquidity and earn yield like that. But unfortunately, the longer you stay in a pool, the more likely it is, statistically speaking, that you don't get to profitability. It actually doesn't work that way, where if you just sit in the pool for longer, you're more likely to get to profitability. It actually becomes less likely because you don't have a statistical edge. In fact, you're trading against the house. The house is informed. Your assets in the pool are not. So you do not have an edge as an LP. And to think that if you provide liquidity and the asset moves lower within your range and you essentially DCA in to that asset, to think that DCAing in on the way down within your range is a profitable strategy, that is false because of your gamma, your impermanent loss. If you are being converted from stable coins into a volatile asset within your range as an LP on the way down, then your impermanent loss is just racking up. And so you would have done better to just hold those assets. And then if you want to buy something, buy it spot. But DCAing down into an asset as an LP is not a profitable strategy. And getting DCA'd out of a profitable asset on the way out, on the way up into stable coins, that is also not a profitable strategy. You would be better off doing nothing and just holding for the vast majority of these pools out there. The only time
in DSI, not to say that you can't make money in an LP, it's just more often than not, most people end up losing money because they stay in those positions too long, really.
So here, let me address.
I fell into that trap, and I know that it sounds like that you've made some money, in some of these positions. And we'd have to look at all the different variables. We'd have to know those positions. When you entered, what your ranges were.
So I can speak to that real quick. Just I know we've run out of time here, Mike, but I just want to address DSI's final comment here. So he says that he's been an LP for a long time. Most of his positions are profitable, but he says that he doesn't know about options. So when you provide liquidity, you can, of course, make money in US dollar terms. Here's the problem. If you look at your P&L on the screen and it tells you a positive figure in US dollar terms, what it is likely not telling you is what was your cost of volatility. Did you make money compared to doing nothing? Did you make money compared to just holding and doing nothing? And I would submit to you, DSI, that unless you're really carefully tracking your impermanent loss, I think that you likely didn't make money, brother. I was an LP professionally for years, man, for years. And it's easy to look at a positive number on the screen and think, I'm making all this money. It's an illusion. It's not real. There are very, very few pools where you're actually profitable compared to holding. And you don't have a statistically profitable edge as an LP. So you've really got to track your impermanent loss. But I'll leave it there.
Awesome. I definitely, that's definitely valuable information. And thank you, DSI, for asking all the questions. We love when the chat engages like that, because that's why we're all here, is to learn. And I'm not above it. I was in LPs, back when we were doing DeFi, crypto, and airdrops, and me and Jeff, and full transparency, it was me getting into DeFi. There was nobody out there that was offering a DeFi education unless you were willing to pay them thousands or tens of thousands of dollars, because it's super complex. As you all just heard. That's just the tip of the iceberg. So that's why we partnered with David, and why we started the Node is we, like me, David, and Jeff, genuinely just want to learn ourselves, keep learning, but we want to help all of you be educated so that you can invest in these assets and invest in DeFi and maximize, not guarantee, but maximize your chances to be profitable. So with that, we built out the Node.pro, and on the Node.pro, like I said, Others out there charge a good amount of money for programs. We give it away for free. So, I mean, again, I'm not shilling anything here. We're giving this away. I'm not saying come out, and buy our buy our system or anything like that, or buy our signals.
No, the stuff is free.
Yeah, just go to the node.pro. There's no gimmicks. There's no tricks. Just click on learn. And you can, if you're a beginner, intermediate, or advanced, or if you just want to start the first lesson, just click on it and off to the races. This is professionally structured. David built this, and he's built a bunch of the different programs. We won't name them, but he built a bunch of the programs that are out there that other channels are using. Either in part or in full,
and charging thousands of dollars for.
Yes. And we are giving it away for free. So we cannot stress this enough. We are here as educators, not influencers. Yes, we do have things that we charge for, but they're things to take you to the next level, not entry level. All the entry level stuff and even some of the advanced stuff we give away. So I'll get into that here in a second. But,
so really, Mike, all we charge for is our time. So if you want to join the premium live calls, that's some of our time.
Or if you want the one-on-one coaching,
or if you want bespoke coaching,
any of the stuff any of the stuff that's built out, like DeFi University, we give it away. Intel Library, this is all of the deep dives that that we just got done doing. Lighter and Robinhood, these are all of the deep dives that we have done so far, just in the past couple of months since we started doing this.
And Mike, this stuff is all searchable. Anyone can jump in here and use the search and find information on any of these protocols that we've done deep dive research on.
Yeah. And if you're thinking about investing in any of these, I highly suggest that you watch these, and not just watch them. It has the video, but there's all kinds of data that you can go through and learn, at least get an idea of, what is the product or service that this that they're offering. And if there is a token, because some of them don't have tokens, we do stocks as well. Different companies like Micron and stuff like that. But it will give you an idea of if there's value capture for the token. There's a slide deck, so basically a PowerPoint presentation on it. There's an infographic. There we provide the source material, for these projects as well with hyperlinks. So if you click on it, scroll all the way to the bottom. We cite all of our sources. I cannot stress enough that anybody that doesn't do this, be cautious. We give you hyperlinks to all the places that we sourced our information to come up with our deep dives. So if you find that we got something wrong and you can cite your source and show that we got it wrong, more than happy to change our material. Again, no egos here. We are here to learn as much as you are. So if you can educate us, thank you. It's just that simple. So again, just yet another thing of massive value that we give away here at the Node. Now, what we were talking about, the coaching. If you want to do a no obligation exploratory call and schedule that with David, it's a live one-on-one video call where you can go back and forth with him for 30 minutes, talk about your portfolio, your risk profile, what it is that you're trying to accomplish, where you're at in your education. And together, you can decide if there's value in the coaching program for you. If there isn't, then no harm, no foul. If you need to get some things in line as far as your education, he might steer you towards a couple of modules in our no-cost DeFi University. Tell you to
so Mike, what I typically do with clients, and I've worked with over 400 private clients over the last 5 years in greater than 30 countries. What I typically do with clients is find out what it is that they're looking to achieve. Most people just want to be able to build a skill set, a crypto and DeFi Web3 skill set. And what I usually do is help people avoid making mistakes. And so, that's actually, very fulfilling, man, because most people, when they jump into crypto and DeFi, it can be very overwhelming. there's so much to learn, so much to know. And that's why we put together all this education.
Mistakes to make.
Yeah.
I made a bunch of them, before I met David and, started learning. Cause like I said, I didn't have the money to, pay $10,000 or more for a DeFi education. I wasn't, going that deep into these, liquidity pools. I was doing a couple $100 here, a couple $100 there, trying to figure it out. I didn't, if I was going to make mistakes, I wanted to make small mistakes. I didn't want to make big mistakes. So yeah, I can't stress enough that, utilize these free tools that we're offering. Also, community. So we have a no cost community for, all of you to join. It's basically kind of like a Discord, and you can come in here. You can ask questions, like I said, welcome, come. Oh, hold on.
So something that's really cool though, Mike, is that from the Learn tab or from the Intel library, from any of those pieces of deep dive research, you can post them in our community there. And then on the bottom there, where you can write messages, you can click on Intel. And when you click on Intel right there, then you can search through all of the deep dive pieces of research. So if you want to jump into the community and cite your source and say, hey, you know what? I think that this project is going to perform really, really well because of this piece of information. We can have a conversation about it right there live in front of everyone. And you can get all sorts of input from everyone else in the community. And you can DM everyone else in the community too. Pretty cool. Yeah. And you can do the same thing with the lessons, the educational content right there.
Yep. So like if you have questions, or you think that, again, you think there's some, inaccurate information in the lessons, you can actually link to it and, tag David or me or something like that and say, hey, could you check this and make sure this is accurate? Absolutely. That's why, like I said, that's why we're here. We're all here to learn. We're all here to make money. And
we're leering.
We're all leering. So anyway, that's all we got for today. I believe I don't have the schedule anymore to reference, but actually we made some changes to the YouTube. So if you could, if you're watching on X, if you want to come over here and find us, and if you could give us a like and a subscribe, but we're at the Node Network, all one word. I separated out our Sovereign Soil and Red Pill shows and moved those over to our brother channel, Unfiltered and Sovereign. So those are going to be housed over there now. So go ahead and join that up. If you're into homesteading, if emergency preparedness, if you're into guns, if you're into outdoor stuff, I'm going to be probably starting a new channel here in the coming months. Me and my brother Taylor and my nephew are starting an adventure guide company. So we're purchasing a piece of property up by where I'm at here, and giving kayak tours, camping tours, hiking tours, hunting, fishing, all that kind of stuff. And so I'll be doing videos on all that, just kind of videotaping. It'll probably just be cool stuff to watch, so you can kind of live vicariously, through me. But those that don't know, I'm retired military. 10 years ago, retired, sold everything, moved up in the middle of nowhere, lived in a tent, built my own cabin. And so I've had people kind of pushing me to share that experience, and that's kind of where that came from. So that's kind of who I am and where I come from for the those of you that are new to the channel. But yes, Tuesday, we got Crypto and Chill tonight, and no, we don't have blockchain, but we do have the market wrap. So if you want to join David, 1 p.m. Pacific, 4 p.m. Eastern, he does a daily market wrap. So it's basically 15 to 20 minutes of TA where he just goes over what happened in the markets that day. Great resource. If you're looking to learn TA, learn how to trade, learn how to read the markets, read the stars, whatever,
we focus on astrology.
Yeah, male astrology.
I'm just kidding. We do not focus on astrology.
All right. So yeah, tonight, if you want to join us, Crypto and Chill, me and Jeff will be talking about some crypto stuff and relaxing. But till then, thanks for joining us. And if you could, again, please give us a like, give us a follow. And until next time, Veteran Crypto out.
Peace.